And our breaking news coverage of this massive Santa Claus rally rolls on. The Dow soaring nearly 1,100 points. That's right, 1,100 points for the biggest one-day point gain ever. Now, not to be outdone, the S&P 500 surging nearly 5% for its best day in a decade. No doubt, investors, CNBC viewers, and listeners are happy right now, especially coming off of Monday's 600-point fall. But here is the trillion-dollar question. Is today's rally a sign that the bottom is in? And is this the start of something great? Or just a huge day in a weakening market? Because, and I hate to do this, glass half empty, the two other biggest point gain days for the Dow, point gain days, 2008.
So it's funny. Before we got on the desk, I
said
nothing
funny about 2008.
Well, there's nothing funny about that, but it's funny about how this felt today in terms of the volatility that we're having. It felt very much like those rallies we would get in 2008. That is not to suggest that this economy or market or is anything like that. What I think we had today was people just said, listen, we've priced everything in. We've priced in all the concerns that we had. Sounds like Powell probably has his job. Chairman of the Federal Reserve has his job for the next 90 days, maybe 180 days. Sounds like the Fed is going to be somewhat dovish over the next 6 months or so. Sounds like maybe we're getting some movement on the shutdown. And then, you know what? Maybe we get some movement on the tariff talks, and you've priced everything in. So people are short. You come in, and you get a nice little rally.
How much of this was just a short-lived, short-covering rally, though?
I don't think it's short-lived. I think most rallies start with that short covering, right? But because we didn't fade at the end of today, that gives me a lot more hope that this is actually something real.
One other thing there, too, is that the tax selling, that was a big piece. I talked to a portfolio manager today, and he said that he basically cleaned everything up by the end of last week, and obviously that's been weighing on some of these
that he was
funds.
selling.
He was done
clients.
selling for the clients, and that may have played a little bit into some of the action today, getting that stuff cleaned up.
Okay, so hold on for a second, because Pete Najarian, here's my question, though. Again, what a day. Okay, nobody's taking anything away from the day. Yeah. But what I want to know is, here's what I want to know. What is different today than 48 hours ago when the market fell 600 plus points, worst Christmas Eve ever? Yeah. Suddenly, everything's okay. Now, Brian Kelly's going to tell you, Powell's going to stay at work. Maybe we get a rate cut. Trump didn't tweet today. What's different today than 36 or 48 hours ago?
And I'll give you this. How about potential of maybe something happens earlier? If you saw Zero Hedge today talking about maybe something happens a little bit earlier in terms of China negotiations. We talk about the trade talk all the time. I agree with Brian Kelly. I mean, the news did change somewhat, Brian, but I'm going to give Brian Kelly a little something as well. We talk about algorithms on the downside. I'm going to talk about them on the upside. I think what we were seeing today, once again, was these algorithms that were triggered, and when they triggered, they started moving to the upside. This wasn't just short covering. This was computers that were moving to the upside. So it's not just on the downside, Brian. It happens on the upside as well.
Well,
that's what I think really was
totally
the
agree with
today.
you on that, Pete. We talked about it last week, right? Everybody blames the sell-offs on these algorithms. But you know what? Quants work on the upside and the downside.
Sure can, but does it make it BK a healthier market? I mean, listen, most people own stocks, they don't short stocks. Hold on. Most people own stocks, they don't short stocks. That's why they tend to be happier when things go up. We make money. That said, this is, to me, when oil goes up 10% on nothing fundamental changing from yesterday. Not a healthy market.
You could say the same thing last week when oil went down and when the S&P went down.
No, because there's too much oil.
Let me jump in here, too.
Computers are part of it. They're not causing it. They're an accelerant to this. We've talked about it even since 1987. They said, oh, the crash was because these new computers. This is just part of the market. It doesn't.
Chris Harvey.
So I think Gene is onto something. I think it's the January effect coming earlier. So what you have seen is you've seen selling. You've seen liquidations, deleveraging, tax loss selling. That all ended. And let's roll the clock back to Sunday. It was amateur hour. This one was going to fire that one. This one's sneaking around to banks. And if you wanted to instill confidence, that's not the way to do it. We watched that all out, and BK's right. You have so much negative news in the marketplace. It was Powell. It's a Fed mistake. He's going to be fired. The economies are rolling over. And finally, what we have is a little bit of good news. And I think what's happened is the selling has stopped.
Okay.
We've gotten to that
Chris,
point.
You're probably going to dodge this question like dodgeball in 5th grade, but here you go. Scott Minerd brought this point up today, which is you've got kind of missteps all around, okay? The Mnuchin email, the Sunday massacre, whatever you want to call it, sparking a little fear.
No doubt.
You had Powell with his unfortunate autopilot comment sort of offhand.
Yeah.
You've had the president's tweets, I'm tariff man.
Right.
We don't need to be political, but today nothing happened. politically. It was quiet. Is that what the market needs?
So sentiment has broken. What you need is sentiment to improve. You need quiet. You need nothing negative to occur. If you get nothing negative to occur, you can see a lift in the marketplace.
I think the other big part that we're missing here is that when we talk about 2008, that brings back that we're not through the worst of this. But 2008, there was something that was fundamentally wrong. Obviously, what was going on in real estate. 2000, a lot of people lost their jobs, these companies that came out. Right. So this, to me, is you talked at the beginning of the show about, are we at the bottom? I'm not going to say we're at the bottom, but I think this is going to be a turning point of the market over the next year, because fundamentally, nothing has really fundamentally changed in this market. I think investor confidence is going to spring back.
Well, if nothing has changed, okay, let's say we agree with that, Pete Najarian. That means 11 months good, 1 month very bad, right? December has been terrible. I don't need to tell you all the superlatives. Awful. Worst month since whatever, insert Great Depression here. So what's right? Is 11 months the way the market's going to go? Or is this month the way the market's going to go?
I would say this. I would say there's a velocity issue that we're dealing with right now. When we talk about the algorithms, a lot of that really does trigger velocity. I will say this as well, Brian. I don't know how many guys were talking about this today, but in the derivatives markets, long before we started to move to the upside, the first hour of trade, as a matter of fact, we were primarily moving back towards the downside, going into negative territory. There were buyers of spider calls. There were buyers of triple Q calls. When you go to the XMI, the XL, all these various indices out there were getting bought up in huge numbers, and it's all very short term. So I'm not sure that I heard Brian Kelly exactly correctly or not. So I'm just going to say this. I think this is trading. This is not investing. When I look at where people were looking today, they were going out 1 week, this week, 2 weeks, 3 weeks, but they were going out into January at most, expecting these moves to be very rapid and then pulling back. And when you look at the volatility index, we talked about this for a while. When it was in the low 20s, a lot of guys were saying, hey, you know what? I think we pull back from here. No, we are trading right now in a marketplace that deserves a 30 type VIX that we're seeing right now, because we're getting 2 and 3 and today 5% moves out of the major indices. We're actually still too cheap going out at a 30 VIX right now than we should be. And matter of fact, we were at 36. We sold off somewhat down towards 30. I think a little bit of that coming back at the end of the day specifically. But I'll tell you what, we are too cheap even at a 30 VIX right now if we're going to have these kind of moves, and I think we will towards the end of the year.
And a VIX that's up 260% so far this year. All right, Chris Harvey, you slashed your 2019 S&P 500 target late last week, but up until then, you'd been a bit of a relentless bull, calling for a year-end rally last time you were on this show. Look.
I think we can easily get to 2,900, so not that far away. Again, we've had a 6-point swing in a matter of in 24 hours, 24 hours of trading, or a little bit more than that. So you can easily have that positive news come back into the marketplace. That's not a surprise. We're sitting around 2,700. We weren't sitting around. We tested 2,800 not that long ago.
Now, the S&P 500, Chris, down about 8% since then. You cut your 2019 forecast from 3079 to 2665. What made you change your tune, and how does today's rally, if at all, impact that thesis on the S&P?
So today's rally doesn't impact it at all. What impacts it is sentiment has been broken. The Fed is telling you they're going to be reactionary, and that negative feedback loop has been closed. We still think equities can move higher, but the ceiling is lower at this point in time. We were teetering. So before the Fed said what they said, sentiment has been dented, right? Then what they said is we needed a one and done. They didn't give us a one and done. And I can tell you from the conversations I've had, people are now listless. The institutional investor, their confidence is broken. That needs to come back. The other thing is the Fed is going to react to negative news, but the markets are not going to wait for the Fed. And so what is the market going to look like when that negative news comes around? Lastly, and we've been talking about this a little bit, is that it's starting to feed back into the psyche. People are saying, I'm going to wait. I'm going to wait to invest. I'm going to wait to invest in that property, plant, and equipment. That feeds back into the economy, which feeds back into growth, and then ultimately feeds back into equity prices. So we still think...
If they missed the rally today, if they were out, and we 5% gain today, 10% if you were in oil, is it too late?
I don't think it's too late, but you don't want to light your hair on fire. You want to be very selective. REITs, you can buy. Some of the biotechs I think you can buy. Some of the hardware names, some of the software names I think you can buy. But you have to be rather selective.
So what's interesting, what's changed was when Chris was here in the past, is the Fed funds rate, what the market is expecting the Federal Reserve to do, has changed a bit. The probabilities have changed a bit to the point where the Fed is expected to be a little easier. So if you're looking for an entry point, I agree with Pete Najarian. I think this is more of a tradable bottom, let's call it. Let's call it for the next maybe 30, 60 days or something like that. You have a chance to trade this thing. But this is deep end of the pool trading. You're going to get massive volatility. You have to be prepared for that.
Pete?
Hey, Brian, you're exactly right, and this is an incredible opportunity, I think, from a trading perspective. First of all, you've got volatility, let's call it above 30, right? And so you've got that in your favor as well. Then you look for the fundamental story, if indeed you're not going to be in the derivatives market, where I primarily am, but if you're in the actual stock market, there are quality names out there, and we've seen more and more folks that are willing to start stepping in. As a matter of fact, some of the smartest guys I know were calling me today talking about, hey, I'm looking for names that are PE names that are somewhere in the single digits. These guys have great cash balance sheets right now. They're not leveraged. I'm going to start nibbling on some of these stocks. Well, you also have an incredible volatility. You can sell against some of that. So I think it does create an opportunity even for some of the longer term. But in the short term, yes, this is trading, because that's the environment we're in and because the algos, and we see where volatility is right now.